Good afternoon from London, and thank you for joining the Rede Masterclass on navigating NAV financings. I'm Mike Camacho, a member of the Rede Partners transaction team in London, and I'm joined by my colleague, Max Barnes, also based in London. And we're pleased to spend the next 45 minutes discussing NAV financings with you. In early 2020, Rede saw the opportunity to extend its best-in-class fundraising and secondaries capabilities into the NAV financing space. And since then, we've built what we believe is a market-leading practice. We thought we would take the RedeConnect opportunity to share our learnings from the deals we've worked on, provide you with a roadmap for how to navigate this relatively new technology, whatever part of the PE market you occupy, and provide some bold, or not so bold, predictions for the future of this space. So we hope that's what you signed up for. If not, there's still time to bail. Don't worry, we won't be offended. We are speaking to you live from London. I'm just a stone's throw away from the BBC broadcasting house, where I'm trying to draw some inspiration. And we have about 150 attendees on the line, before dropouts, of course. And it's a mix of limited partners, general partners, lenders, and other advisors. We're going to try to leave time for questions at the end, but no promises. We are on a very strict timekeeping regime. So we hope it will be useful to all of you. Let's dive in. NAV financing is just being discovered by many private equity sponsors. It goes without saying that many of the same objectives that can be accomplished with equity can also be accomplished with debt. Continuation funds or top-up co-investment funds are not the only way to raise additional capital for a portfolio, nor is an exit or a strip sale the only ways to generate proceeds for a fund. Furthermore, there are advantages to applying leverage at the portfolio level versus at the company level. Cost, covenants, PIK versus cash all come immediately to mind. Used effectively and in the right situations, they can be yet another powerful tool in sponsors' toolkits. Anecdotally, we've seen a surge in uptake of NAV financings over the past 12 to 18 months, but it remains an opaque market. Therefore, we only have estimates of market sizing, which we present later, and we'd be interested in hearing whether you agree with our estimation. Rede would like to play a role in providing more market statistics, and we hope many of you will help us achieve that goal. How does it concern me? Not as in Mike Camacho, but actually you as in whoever you are, is a theme we address later on in the presentation, which is why I suppose we put an iceberg on the page, but at this point, I don't really remember why. No Titanic references, we promise. Certainly, our view is that if you are a participant in private equity, you should be well-versed in NAV financings and know the answer to this question, and hopefully we can help. Great. So we thought we would quickly start with the basics. What is an NAV facility or an NAV financing or portfolio financing? We'll use the three terms interchangeably. Really, it's pretty simple. These are loans secured against a single private equity fund. That means typically all of the existing portfolio companies in a fund, plus the future portfolio companies yet to be invested by that fund. These loans are arranged by the private equity sponsor managing the private equity fund. Many of the principles of NAV financings also apply to preferred equity, but not everything. And really, what we will be focusing on here is debt or NAV financings. We've illustrated this graphically on the left-hand side of your screen. It should be considered a financing of the equity positions of a portfolio of companies, sitting in principle junior to the portfolio company level debt, but senior to the equity of the limited partners. The loan-to-value ratios, or LTV for short, for NAV financings range widely, but do not typically exceed 25%. The NAV financing lenders typically have access to the proceeds of the portfolio companies upon their exits, but not their free cash flow, which is why they're often paid in kind, i.e. accruing loans, rather than cash paying. Most NAV financing facilities allow limited partners to receive proceeds under certain conditions, i.e. under a certain loan's value, which is colloquially referred to as leakage. NAV loans are used for a wide variety of reasons, but effectively serve the same purpose as equity funding to a portfolio. They can be used for add-on investments or equity cures, often when the PE fund is tapped out. They can be used to distribute proceeds and any combination of the above. In short, they're one of many portfolio management tools available to sponsors today. NAV financing facilities are the second most popular type of fund financing, although admittedly a very far second to subscription lines or sublines for short, which are ubiquitous. Whereas sublines are backed by the LP's committed capital and are used as a fund is drawn. An NAV loan needs some assets to back, and those assets must have some history. Therefore, NAV loans are typically done after at least 2/3 of a fund is invested, and there is evidence of value creation in the current portfolio, the V in LTV. The greater the V, naturally, the greater the quantum of an NAV loan is possible. We have seen NAV loans executed as late as year 10 of a fund life in order to further invest in the portfolio when calling capital from LPs is no longer possible. These are an interesting alternative to a continuation fund and naturally does not involve the transfer of assets to a new vehicle nor any transfer price determination. The benefits of a portfolio financing are numerous and not limited to what we've listed out on this slide. IRR improvement, that's pretty self-explanatory. Naturally, if a distribution is accelerated, that helps the IRR of a fund. It can provide liquidity to a fund, jump-starting DPI. This helps achieve fund objectives earlier, often buying patience for the fund to allow the strongest assets to be held for longer and to generate more value for the fund. These facilities sometimes create recallable capital, depending upon when they occur and how they are classified, which can help increase the firepower of that fund. For example, we have seen a sponsor use a facility to allow the fund to be 100% invested in deals. That is over 100% invested naturally with fees. NAV facilities are also an efficient way in which to generate a sizable distribution using the built-up value of a portfolio without burdening the companies with additional direct debt obligations. We did want to address a few common concerns we hear voiced about NAV financings to help demystify the process as well as share Rede's views. The first concern is that it's just adding leverage upon leverage. Lenders are very careful about adding leverage to already levered portfolios. Rather than an NAV facility being additional leverage, it is often an alternative to portfolio company refinancings with benefits with respect to overall cost and flexibility. In Rede-advised NAV financings, we observed that the overall equity cushion, defined as equity divided by enterprise value, only decreased modestly after the introduction of an NAV line, and we'll present these statistics on the next slide. Common concern number 2 that we hear the term cross-collateralization being used a lot in the context of reasons to be wary of NAV financings. The reality is that there is a strong interrelationship between all assets within a fund because a sponsor is motivated to produce a good outcome at a fund level for their LPs and for their franchise. If one asset were to underperform, a sponsor would likely aim to seek outperformance from another asset. Many worry about a workout scenario and a debt spiral. What we see is that typically there are conservative enough gearing levels such that not all portfolio companies are impacted in a workout scenario. Rather, the sponsor would need to choose one, possibly 2 assets to sell to bring the LTV levels back to within compliance, rather than to repay the entirety of the facility. Naturally, this depends upon the specific scenario and the LTV, but we have not observed unreasonable usage of the NAV financing market because neither lenders nor sponsors entertain it. Another thing we often hear from sponsors and LPs as a reason to not consider NAV financings is that because the whole portfolio is collateralized, then the lender can take control of the entire portfolio in a default scenario. More often than not, we see structures where the facility is effectively unsecured. The assets are pledged to an aggregator vehicle. Cash flows are due to the lender via a preferred equity construct. But in a workout scenario, the lenders cannot take control of the assets. Rather, the sponsor must present a plan to bring the facility back down to a level where it is compliant, for example, down to the opening LTV, typically within 6 to 12 months of the covenant breach, and sometimes even more. However, at no point can the lender touch the assets. Then on the flip side, when the sponsor seeks such an unsecured facility, Many lenders worry that they are powerless and can only sit and wait for the sponsor to solve the issue. While the documentation may imply that, the truth is that sponsors are quite motivated to make sure that their funds are a success, and a default of any fund level facility would be a disastrous franchise killing scenario for them. We believe quality sponsors would make a good faith effort to solve any issues with an NAV financing, as they first and foremost are looking to protect their funds, their LPs, their performance, their reputation, and ultimately their business. We see that the most successful NAV lending parties understand this dynamic very well. They see it as an underwriting of the franchise rather than a hard trade. Lastly, we often hear a concern from LPs that it's only done to accelerate a GP's carried interest. We don't believe that the GP alignment with LPs fundamentally changes as a result of an NAV financing. The cost and the cash flows of the facility are accounted for in the fund performance, and the LPs and GPs alike benefit from the effective use of NAV facilities. While carry may be accelerated as a result of an NAV facility, DPI may also accelerate, IRR may also improve, outcomes of portfolio companies may improve, companies may be saved, and the list goes on. More broadly, Rede does not see the proliferation of NAV facilities as a good or bad thing in and of itself. We see it as a tool that, when used effectively and responsibly, can achieve various objectives and make sense for all of the involved stakeholders. On balance, we see that attractive sponsors in today's market have been able to negotiate very LP-friendly terms. As mentioned on the prior slide, in Rede advised NAV financings, we observed that the overall equity cushion only decreased modestly after the introduction of an NAV line, from 69% to 64% on average, over the deals completed in the last 12 months. Thus, not only did we observe modest decreases to the equity cushion, but we also observed that the resulting equity cushion is unlevered. This reflects the fact that often these portfolios have already delevered significantly prior to the introduction of an NAV line. We've entitled the next section Anatomy of an NAV Financing, where we lay out the steps involved, common terms, an example timeline, and what we see as the key success factors. In broad strokes, these 5 steps are what happens from the start of a process until its end, and we'll discuss many of them as we go on in the presentation. The most important thing to not overlook is to understand whether the LPA's language permits an NAV facility to be put in place. Sometimes it's not black and white, which is why the dialogue between sponsors and LPs is crucial. So let's dive into some typical terms. What is a typical opening LTV? We've worked on transactions from sub 10%, as low as 2%, to above 20% LTV. If you go above 25% LTV, this tends to veer into preferred equity territory, but this naturally depends upon the overall look-through leverage of the portfolio. Typical size, they really can be any size. Institutional lenders tend to start to be interested at $25 million or so, and some of the larger facilities we have seen are around the $1 billion mark, but there are exceptions. We understand that SoftBank took out a $5.1 billion NAV loan earlier this year for their Vision Fund. Margins, naturally, they can vary quite significantly, but we see most of these getting done at a base rate plus 4% to 9%, with ratchets upwards and downwards depending upon how LTV develops. We often get asked how banks and credit investors differ in terms of this term. The truth is that it very much depends, but we do see that credit funds often need to make an all-in return of 6% plus. That being said, banks often require some additional bells and whistles in order to help them achieve those lower rates. Upfront fees, these are important to lenders in order to help them make their desired returns. They're typically at least 1%, often structured as an OID or original issue discount. The term of these loans, anywhere from 3 to 5 years, with extensions, typically at the discretion of the lender and subject to an extension fee. For banks, 5 years is typically the longest duration that risk officers would accept. Thus, any extensions would need to be done at the lender's discretion. Credit funds, however, can sometimes provide more flexibility here. Cash sweep, this is an important element of any facility, and it governs who gets what's cash and when. Sponsors, lenders, and advisors have really notched up the creativity in coming up with all sorts of cash sharing schemes. Importantly, LPs are less and less likely to go blind at the expense of cash flows due to lenders, due to LP-friendly terms being negotiated by the sponsors. Recourse and security, this is something that goes hand in hand, and it's something that we touched upon briefly earlier. Many sponsors prefer a non-recourse loan, which means it is effectively unsecured. Lenders only have rights to the cash flows of the portfolio, i.e. from exits, and cannot touch the assets in a default scenario. But this does come at a premium in terms of margin, and many sponsors decide that this is well worth that premium. At the other end of the spectrum, sponsors can also pledge the uncalled capital, which has cost benefits. Covenants, importantly, those typically relate to things like concentration of the portfolio, number of assets, LTV. For example, there is often a high value kickout. So if one asset is worth, say, 33% of a portfolio, and the diversification limit says that one asset cannot be more than 25%, then that 8% related to that large asset is kicked out. So how quickly can these get done? If structured and executed well by experienced parties, these can be done start to finish in as little as 10 weeks or 2.5 months. That is including prep time, which is actually rather limited. Most lenders can make a go, no-go decision on the basis of a quarterly report and valuation methodology. Lenders are also accustomed to moving fast and therefore can often respond to a term sheet proposal in 2 to 3 weeks. They are also accustomed to being very resourceful and executing due diligence in an expedited and relatively painless fashion for the sponsor. We are often asked to summarize our key learnings about why some NAV financings close and others do not, so we thought we would list out a few on this slide. First, it is important for a sponsor to be able to have a clear rationale for why an NAV financing is additive to a fund. That rationale should be communicated to LPs, lenders, portfolio companies, all the same, and naturally, it should be the same story for all of them. A sponsor, with the help of their advisor, should also be able to explain why an NAV financing was the chosen path, rather than the myriad other options available to them. Secondly, it is important to have realistic expectations. Yes, I too would like to be able to issue an 8-year facility with 30% LTV, unsecured, 100% headroom, and a 3% PIK margin, but the market for such a facility does not exist yet, at least on planet Earth. The third point, and may seem rather obvious, is to identify existing lender relationships. That could be subline providers, lenders to sponsors, portfolio companies, and even limited partners with lending activities, and make the right connections within those organizations. Most of these institutions have many different teams, business lines, and reporting lines, and identifying the right path can be key to getting lenders to go the extra mile for a sponsor. Next, it's important to run a tight process to create competitive tension, build momentum towards closing. These processes can be fast, as we just illustrated, but it is often a heavy lift, and the work should not be underestimated. Naturally, as an advisor, it's in Rede's interest to say this, but we do thrive off the intensity that an 8 to 10 week process brings, and naturally we have a lot of experience in this space as well. With respect to the LPA, 2 important points here. One, the spirit and the letter of each LPA needs to be examined to understand if there's a path to implementing a facility. Secondly, the details around how an NAV facility are structured are of utmost importance. The legal aspects of an NAV financing are almost as important as the commercial. Lastly, and rightfully coming full circle, LP management and the appropriate consultation with LPs is a crucial part of any successful NAV process. Communicating early and often with LPs and providing the right level of detail around the final result is of utmost importance. This is not the kind of thing that you sweep under the proverbial rug. The next section focuses on the most important stakeholders in any NAV financing and what are the key questions and considerations for each. A key part of what Rede does across the entirety of its business is to provide holistic advice that takes into account the key interests of all of the stakeholders in any transaction. We've identified the 4 key stakeholders in NAV financing as naturally the general partner, limited partners, portfolio companies, and the lenders. So as an LP, when discussing an NAV facility with your sponsor relationships, we would advise you to focus on the 3 key topics that you see here. You should ask them, what are you looking to accomplish? When will we see the benefits? Now, later, both. What is the underlying motivation? What is the trade-off? What are your incentives? If this helps you realize proceeds earlier, how will you use those proceeds? How will this impact the key professionals and partners at your organization? We always encourage LPs to look at the overall leverage picture, the so-called look-through leverage. Is this reasonable given the type of portfolio and underlying exposures? How much headroom is there before a discussion needs to be had with the lenders? What would happen if there is a rainy day? How much time do you have to fix the problem? Is there a step up in interest rate? If so. Lastly, I would focus on the overall cost. Too often LPs ask what is the interest rate, but it's really much more than that. There are upfront fees, uncalled fees, ratchets in terms of interest, cash discounts, that is a lower interest if cash interest is paid. All of those things that should be taken into account. The costs will also change over time as the facility develops and is eventually paid down. It's also important for LPs to ask how they arrived at the lender selection, or in some cases, lender consortium. While the relationship banks and lenders are an easy choice, there are many providers who provide a lot of solutions that the incumbents may not be able to provide. Sponsors' questions for lenders revolve around 3 key themes, in our view. Can you meet our objectives? What are your motivations? And how will our relationship look like going forward during the term of the loan and potentially beyond? Firstly, it's important to understand whether there is a meeting of the minds between you and the lender, and that manifests itself in being able to deliver the best possible terms for the facility. Execution track record is, of course, very important. As a relatively new asset class, not many lenders will have a long track record in terms of actual time, but many lenders will have been pretty busy since 2019 and 2020. So probe on this. Can you underwrite the transaction? That's particularly relevant for large transactions, i.e. those above $500 million. Not many lenders will want to hold $500 million tickets, plus tickets, but some can and will underwrite, and that affords the transaction a certain level of certainty, or it affords it uncertainty. Lastly, what is the actual source of your funding? Is it discretionary funds, balance sheet capital, or are you involving co-investors, key relationships in the insurance sector? You should naturally understand what their approval processes are as well. We find that this is much more prevalent than in the secondary space, for example, where you generally know who is the funding base. In lending world, it is a bit different than that. It's also important to understand a lender's and the key professionals' objectives. So find out their approval process. Who will be approving this loan? Is there a risk officer involved, a CIO? Who will be performing due diligence on the assets? We always think it's a good idea to probe on an individual's KPIs. Are they motivated by total volume, deals originated, or return profile and portfolio construction? Which leads us into the next question. You should ask them, or you should find out rather, if they're motivated by a P&L statement or by carried interest. Some institutions will be interested in showing total relationship returns. So they will ask themselves, will this yield us more M&A or leverage finance business, typically banks? is this seen as a balance sheet cost to drive revenue? Again, typically banks. Or are these organizations carry eaters and thus more motivated by cash on cash multiples or even faster deployment, which allows them to raise the next fund sooner and grow their AUM? Understanding this well is important for optimal outcomes. And then once a transaction is complete, what do the next few years look like together? Will you plan on holding what you take down or syndicating it to others? Will I be dealing with you in 2 to 3 years' time, or will you have moved on to another organization by then? Naturally, you don't ask that question directly. No one's going to tell you that they're going to leave their job if they're going to provide you a loan, but it is worth looking at the prior team stability because that is sometimes an indication of future stability. What else would you be interested in pursuing together? Naturally, these organizations, these institutions typically have a lot of products and you can work with them on many different things, and an NAV loan can just be a start to that. And then, of course, what if things go wrong? Naturally, the paperwork provides a template for what happens, but you should know what happens practically. Ask for case studies, ask to understand really what are their true objectives. And then lastly, if you are a lender, what should you be asking the sponsor seeking to issue an NAV facility? First, you'll want to assess whether it's worth your time. Is the deal going to get done? And if it is, will it be with you? What is going to drive their purchasing decision? Do they need LP approvals? And if so, have they already socialized it with LPs? What are their expectations on terms, amounts, and timeline? Naturally, you should probe on whether the loan will perform. And most lenders don't need to be told what is important in terms of understanding credit risk, but we do think it is important to assess 1, the look-through leverage picture, 2, the exit projections, which will drive the performance and the repayment of the loan, 3, how the collateral will be improved by future investments, and 4, the risk of refinancing. Naturally, it's important for sponsors to be well prepared to answer these questions. And then the last theme is really, who are we backing? And we believe that the most successful NAV financing parties see these loans as a bet on the sponsor's franchise and longevity. So evaluating the bigger picture, such as how important is this fund to you? How does this affect you as a franchise and as individuals is important. Also, you should ask, what else do you want out of this partnership? So we hope that whether you are a lender, a sponsor, or an LP, you found these key lines of inquiry useful. I'll now hand it over to my colleague, Max Barnes, who will take us through the results of our inaugural survey of NAV financing market participants.
Thank you very much, Mike. And thank you from me to everyone who has joined the call today. We are really excited to be showing you the results of this survey, which is probably a first of its kind. The world of NAV financing is opaque, as we have described, but we'd like to share with you some of the data that we have collected and describe the trends that we are observing in the market. Rede has reached out to all of its key lender relationships who are active in this space, and on an anonymous basis, asked them several short questions. But let's dive into the data. Let's see how this market is evolving.
I'm on it, just a minute. Yeah, there we go.
Thanks, Mike. I'd like to talk to you first about the market size and the volume of deals. The data backs up our observations that this market is growing incredibly quickly. 80% of lenders saw an increase in transaction volume over 2020 to 2021. This is still a relatively small market, with over 65% of lenders seeing less than 20 deals and 90% of lenders completing less than 10 deals over last year. Actually, what I'd like to do here is compare this to the development of the subscription line market, a market that was in its nascent stages a decade ago, but now the subline market or sublines are prevalent feature in almost 90% of all private equity funds. So I guess the question is, will we see NAV financing or the NAV financing space follow a similar expansion? Based on the survey, we know that $12 billion of deals were completed over 2021. We estimate this captures maybe around 50% of total volume. That points to a $24 billion market. Compare this to the subscription credit line market, where in 2020 it was estimated to be as large as $500 billion. If we are correct, then right now the NAV financing market is only around 5% of the subline market. But we genuinely believe that NAV financing, or the NAV financing space, has every opportunity to be as large as the subline market. We'll certainly be kept pretty busy if we are to reach these levels over the next couple of years. I think for this market to really become a new asset class in of itself, of substantial scale, we will need to see greater adoption of these facilities across the board and across geographies. So who are doing these facilities? Are sponsors working with existing lenders, or are they looking further afield? From the chart on the right, it's clear that the majority of lenders have existing relationships with the sponsors that they provide these facilities to. At the end of the day, when we run these processes for our sponsors, it's the best offer on the table that wins. But there's no doubt that existing relationships count for something. And of course, this makes sense. Existings, they know the manager, they know the assets already, and that gives them a head start on the DD process. A relationship also becomes important, particularly when we enter into a syndication process. For some of these larger facilities that we've helped run, often several lenders will make up a consortium of term takers behind the lead lender. Sponsors will naturally favor existing relationships over parties that they have not worked with before when considering allocation. As we have described, structure, security, and returns are all directly linked. The majority of transactions we have advised upon have been this recourse-light structure, i.e. no step-in rights to the underlying assets. The majority of lenders, 65% of them, have executed on deals of this nature, and 85% of lenders would execute on this structure. One question I imagine is on your minds, given today's market and the geopolitical climate, is which direction are margins or interest rates trending for these type of facilities? The honest answer is we haven't actually seen much upward pressure on margins to date. They're still landing in that sort of 4 to 9% mark for these type of deals, despite the wider market movements. If anything, we're probably seeing downward pressure on margins. This is predominantly driven by the current imbalance of supply versus demand. There is certainly plenty of capital interested in deploying in this space. I'll now pass back to Mike for some concluding remarks.
Great, thank you very much, Max. Again, that's something that we'll look to repeat in years to come. And thanks for all of your help in helping us provide some of those conclusions. So we have 2 concluding slides to wrap things up. Thank you for sticking with us up until now. So what are we observing so far in 2022? Sprinkled with a bit of Rede extrapolations for the rest of the year. We see that NAV financings are being contemplated more and more by sponsors for a variety of uses. We also see that LPs are getting a good deal, especially when it comes to their cash flow profile post-implementation, i.e. the colloquial leakage. This also works in the lender's favor, many of whom are not looking to get paid down immediately, but appreciate the opportunity to yield cash-on-cash returns, or in this case, actually pick-on-pick, but eventually cash. We see that it's a deep market. There are many new players popping out of the woodwork. We observed 60 serious lender participants active in the market in 2022, which is an increase on what we saw in 2021, and an increase on what we saw in 2020, or 2021 was an increase on what we saw in 2020. The competitive market has pushed lenders to sharpen their pencils, but we would say that it is not just a race to the bottom in terms of rates. There are many creative solutions, and there are many levers to pull or to play with to make sure that everyone reaches their goals. This is sponsors and lenders alike. Because sponsors all have different preferences, we see that bespoke approaches and increasing segmentation allow the savviest of parties to achieve their objectives. Sponsors tapping the market in 2022 have enjoyed an early mover advantage, and we expect that that will continue to be so. They are able to structure highly bespoke solutions and contribute to setting the market standard. We note, at least for now, a relative supply and demand imbalance, but we don't expect that to last. As Max said, we predict NAV financings to follow a similar adoption curve to subscription credit lines. Leading lenders in the space also help set the standard for future transactions, so it actually goes both ways. Lastly, we see that investors are getting smart on portfolio financings. They're learning about the benefits, and they're also asking critical questions, which is something that we very much support. We also see that many investors are employing a wait and see approach to NAV financings. They have seen some facilities executed 2 to 3 years ago, and they want to see how those perform and how they benefit their portfolio. So looking into the Rede proverbial crystal ball, what do we predict for the future, for 2023 and beyond? We believe that tranche facilities will gain in popularity, especially as the NAV financings grow in size. We have seen that proposals for privately rated facilities are very competitive in terms of costs, as they can gain access to the insurance market and thus will be a force to be reckoned with very soon. Guidelines. Whenever a technology gains in popularity, the PE governing bodies start to pay attention, so that's something to watch. Disclosure and reporting that will be driven by LPs and their demands to understand more detail around how these facilities, how they perform over time, and how it impacts their overall PE portfolio. Back leverage, so that's a colloquial term for leverage applied at the level of the lender, backed by the lender's capital. And that's a way for returns enhancement, effectively. Sort of an NAV financing on an NAV financing is maybe one way to think of it. That's already happening. We expect that to increase. And again, it's a way for credit funds or fund of funds to enhance their own returns. Lastly, we have seen that limited partners, mostly fund of funds, but also pension funds, have had strong appetite to deploy capital in NAV financings. We see that this will grow, driven by LPs' desires to be increasingly relevant in sponsors' businesses. So luckily, we do have some time for 1 or 2 questions, and we have a few streaming in from the audience. Let me just go to the, okay, no. Yes. Okay, the all-important question slide, so great. Okay, one question that we have received from the audience: what type of DD requests do lenders usually submit during an NAV financing process? Really, they're looking to evaluate 2 things. They're looking to evaluate the V in LTV, and they're looking to evaluate the L in LTV. So they're looking to evaluate the potential performance of the loan, and they're looking to evaluate the value against which they are lending. So in order to evaluate what they're lending against, they'll want to understand the valuation methodology and determine whether or not that is defensible. Naturally related to that would be understanding the capital structure. So getting details around that to understand how the capital stack works and where they're actually sitting relative to in the portfolio, across the portfolio and within each individual portfolio company. And related to that, they're also interested in understanding the financial results, which naturally help determine and inform valuations. So that's really what they would be looking for on the value side of things. Sometimes these things are all available in quarterly reports. It depends upon the level of disclosure in quarterly reports. Otherwise, they have to dig in a little bit further to assess whether or not they agree with the V effectively. Again, the starting point, maybe I should have said this earlier, but the starting point is really the GP's marks. So what do they submit in a quarterly report? And that is typically the V. I'd say 95% of the time, that's the V that is being worked off of to provide an NAV financing loan. And then naturally, they're going to try to understand whether the loan will perform and how the loan will perform over time and when they expect it to be repaid. We talked a little bit about the cash flow profile or the cash sharing scheme that will be determined by LTV and determined by exits, and will determine whether or not a facility will actually be repaid within 2 years, 3 years, or 4 years. That's completely separate, actually, from the term of the facility. And in order for lenders to be able to evaluate that, they will need to understand the portfolio exit projections. So what are the GP's plans in terms of exiting this portfolio? What is their base case? What is their downside case? What is their upside case? What is their timing in both of those situations? Understanding that will help them determine what their return will be, what effectively their cash on cash return will be, and then also their IRR. The performance of these can really vary on the basis of how the portfolio actually performs. And there's a next question that I have is, and I think I have time for about 2 more. How diverse do I need my portfolio? Does the portfolio need to be in order to take out an NAV loan? Well, if we can be a little bit academic here, it needs to be a portfolio. So then therefore it would need to be at least 2. And we would say that most lenders are looking for a little bit more than just 2, so probably 3 with some level of diversification within that. So if a portfolio is 3 assets, but it's 90%, 5%, and then 5%, that is going to be a little bit more difficult to get some of the benefits that you would see in a portfolio or an NAV financing. The other thing we would say is that most lenders will try to legislate against being left with a part of the loan outstanding and only one company outstanding. That's typically something that, well, they just don't want to end up like that because that's not against the nature of portfolio financings. Secondly, many of them don't have the mandate to be able to do that, so their investors prohibit that effectively. So that is something that we see. So really, I would say technically 2, but probably 3 or more. And last question that I can address, let me just pull one out. What kind of return enhancement can I expect to see on a fund that uses an NAV facility? Well, maybe let's address it from an IRR perspective, because that's the most natural thing to look at. It can be anywhere from 100 bips to 300 bips, but really it depends upon the quantum. The quantum is really what's going to drive the IRR improvement. Second to that would be the terms, and then probably actually first the quantum, second would be the cash flow profile, so the leakage that can be afforded to LP. So the greater the leakage, then typically the greater the IRR improvement. And then third is the cost. The cost is probably the third most important factor in determining that's IRR improvements. Great. Well, thank you very much for joining Max and I today. We hope you found the webinar useful, and we'd be happy to continue the discussions with any of you offline. So please don't hesitate to reach out.